So let's continue our conversation with the expected returns and realized returns.
Okay.
So is it fair to say that when we talk about expected returns for a client like Portfolio 100, around 11.27% or so, do they see the realized returns year in, year out about 11.2%?
Well, only if they're buying from Madoff.
Madoff, okay. Okay.
So Madoff had a zero standard deviation. Every year he gave a 12% return, 1% a month, basically. And that should have been assigned to people, but I guess it wasn't. But the fact of the matter is, the answer to that question is no. When you look at annualized returns, and we want to look at 1 year periods for the S&P 500, here you can see the distribution of 1 year returns from, and this is over a 50-year period, from minus 45 to plus 62. And so it's pretty crazy. Let me put that back. The range of realized returns relative to the expected return for the S&P, which I just showed you in the previous return chart, was about 10.5 or over long periods 9.5 actually. So does that answer your question or not?
It does, but we have a great chart here, which is the returns matrix. If we, it clearly shows that yes, on a yearly basis, the realized returns are all over the place.
Yeah.
But with time, when it comes to planning, or whether it is 20 years, 30 years, or life expectancy, you would see that the realized returns are very close to the expected returns.
Okay. Well, in large samples.
Yes, in large samples.
Yeah. So I hate to keep using those terms, but the lack of understanding of statistics is the reason investors do so poorly on average. They really don't understand statistics, or they may not accept that statistics applies to the markets. And it does, and an understanding of statistics goes a long way to improving investor behavior, which is a whole other conversation. Anyway, in reference to what you were talking about, Venkat, here is the S&P 500. You can see up here, I've clicked the S&P 500 index as we use in our simulated data here. And one thing you can see is here's the 35-year annualized return. Again, back to that 10.72 number. But in terms of clients realizing annual returns, you can see here what a wide range of annualized returns we see. Here's minus 37, minus 22, plus 32. Back in here we had a plus 32 in 1985. So 33 in 1997, minus 9 in 2000. So there's a very, very wide range of returns, as I just showed you in that last return distribution, that histogram of annualized returns, that dramatically show the difference between what you might expect and what you realize.
You might have realized. Yes.
Now, as you hold it longer and longer, the differences in these numbers become less and less. That's, to me, one of the most valuable parts of using the returns matrix is when I go down the diagonal and I look at all the 25 annual rolling returns. So we see 7.8, 10.5, 9.9, 9.25. Those numbers are pretty close together because we have a reasonable sample size of 25 years.
Yes.
Which gives us a nice averaging of the longer period data.
So how can we help clients, or to focus on 25 years or 30 years, whatever is their life expectancy in terms of rather than focusing on.
That's a $64 million question, I'll
Instead
tell you.
of focusing on this 1 year, because this is meaningless. Yes, these are realized returns in a particular year, but the outcome in terms of retirement planning
Yeah.
or financial planning is something beyond 25 or 30 years on average.
The only way you can help them is give them an education, which is what IFA is all about. From 20 years ago, when I first had this idea to create this company, the first thing that occurred to me is the data wasn't available for people to look at and
Yes.
to analyze
Yes.
and to be able to get some comfort from.
Yes.
And that's pretty much what you can do. You can show them this data that says, no matter what 25-year period we looked at, you did quite well.
Exactly.
But it's 25 years.
Yes.
It's not 5, it's not 10. You just saw the wide range of returns in 10-year periods.
Yes.
From 18 to -1 to 13. It's like, wow. So patience and understanding of capital markets and understanding of statistics are all requirements to help investors capture the returns that are there to be earned.